So we're here to talk about equity funds. And of course, we are attorneys. We're not necessarily your attorneys, but this is truly for educational purposes. We do really value the ability for, if you're out there doing these deals, they're so simply high risk. The liabilities of not doing things properly can be a killer. And we'll cover a little bit of that as we go along. But here's our own CYA. Always have an attorney on board. In addition to that, you need the CPAs and whatnot. And we'll talk about that as kind of part of who is your team. Now, just to kind of really high level it, people think, what's a fund? And you know what, just real quick, I kind of want to differentiate for at least what the difference between a syndication is or a specific business or real estate capitalization and a fund. Generally, with a syndication, when we put together, we designate, hey, we're going to buy this property or we're going to start this company, which is night and day different than doing a fund where oftentimes it's a blind pool. Blind pool means we can tell you what we're planned to do generally, but we don't know where we're going to invest. We draw a target market in the real estate world for the types of properties that we're going to try to acquire or how we're going to invest. A private equity fund, they also may be investing in the purchase of private loans. I'm sure everybody has heard about buying performing or non-performing loans. Non-performing, you make them performing, and then you resell it at a massive gain. Real estate, of course it works, but what people don't really realize or think about is that if you're doing a fund, if you're investing into other syndications, it truly is a equity fund, a investment company fund. And if you're instead just investing directly into real estate, there's a whole bunch of different exemptions and other ways to work with it. So, and really, that becomes very important as you are successful with your business, as you continue to grow your business. Really, the cost benefit of trying to figure out how to stay exempt from registrations or investment advisory type obligations. To the nth degree, it makes things easier for you. And if you don't pay attention to it and just kind of form your fund and fund it and go do whatever with ignoring that, again, the downside could seriously be catastrophic. And so just to kind of, we talked about this, buying stock in other companies, interest in special purpose entities, or all these other types of investment vehicles. Now, with stocks or these other investments into equity funds, it generally, you start a fund, you're investing into whatever these assets are, but even though you're investing in the assets, you're passive. Your services as a fund manager is to choose where to invest the funds, how to allocate it, the underwriting with the investments, and then when the investment is made, you're out of it entirely. That is truly a, hedge fund, private equity fund. It is an investment company. With investment companies, there are some exemptions that we'll talk about, but it's really, it's another level of compliance that you often have to deal with. That, again, the types of exemptions to, let me see if I'll talk about that a little bit. really, if you are thinking about how to move forward with your business, and I have this conversation so often with people that really it's important for you to take into account. If you are newer to the real estate investing or syndication, raising capital business, always, always, always start with specified property syndications. Reason for that is multiple fold. A, well, if you're doing a syndication, the investors know what they're investing into. It actually becomes less about your prior performance, your abilities, and more about literally the properties that are getting invested into. What's the geographic area? How has it been performing? The spotlight gets a little bit less on the management. As soon as you're focused on the private equity funds, well, now the investors don't know what they are investing into other than your own skills, abilities, prior performance, for whatever that means. And it's simply a different analysis. And now you're selling yourself versus simply selling an investment into a piece of real estate. That's one reason when you're really starting off, start off with the syndications, but everybody, after getting their feet wet, really the equity funds and the blind pools will also make your life substantially easier. The reason for that is, frankly, you're raising capital. You may not know what you're going to buy, but your business is already moving forward. And it's far different than doing a syndication where you've got a closing date. You know when you need all the money. You know when you need everything to come together at the end of the day. Maybe you need some bridge capital to get you over the finish line. With an equity fund, you're just out there. Here's our business plan. Here's our target markets of what we're looking to acquire and invest into. And now you can pull the trigger on opportunities far faster than taking we get a syndication done in a couple of weeks under Reg D. It's not painful, but every moment matters when you've got that closing date. With these equity funds, it allows you to have your platform of business. So you can move forward, you can raise the capital. You of course don't want a bunch of funds just kind of sitting around and available, but you're now in better control of raising the capital to use the funds based on your target markets without unnecessary delays. That's really one of the biggest benefits to the sponsors. From the investor side, really it comes down to diversification. If they put all their money into, and they should never put all their money, but if they put a large chunk of their net worth into a syndication, into a particular property, and it doesn't go well, it could be a complete loss, but only on that one property. If the funds are set up to invest into multiple properties and there's a problem with one of them, it's okay. Little hit, but the diversification ensures that your investors still have skin in the game, their investment moving forward. So for that reason, the funds are much more, at least in my opinion, the diversification is such an important component to the overall wealth planning and legacy planning of your investors themselves. Also, when it comes to kind of doing the private notes, and so many people will do we just have a note here with a lender, a note there with a private lender, and that's how we're running our entire business. You also know, and you know who you are, when you're doing that type of strategy, you sell the property, then you got to return the funds, then you have to find another property, then you have to ask the investor, will you re-lend? And you hope if you did a great job, generally they'll say yes, but sometimes they have other needs and other wants with their investment funds. If you were doing an equity fund for single family homes, fix and flips, short-term notes, for all those, well, then you don't have to give the money back. You set it up where there is a period of reinvestment so that you're just running your business. Go buy another property with the funds that you already have, recycle those funds, and continue to grow the fund itself. Now, I do want to bring up a particular issue that I literally was talking to one of our clients about this week. But so he has a fund, and his brilliant idea is, I want to reinvest all proceeds in the fund. I don't want to do distributions or pay out dividends until we're ready to start winding it down. Love it. You got the economies of scale, compounding, it will grow faster. What he didn't think about was most of the time, these funds are structured as partnership taxation. Maybe LLCs, maybe LPs, doesn't really matter. Partnership taxation can apply in multiple different areas. And that's a flow through from the fund to the investors. They receive a K-1 for all the profits, losses, depreciation. And if you structure your fund to enjoy the compounding, which is a great ideal, the investors are still paying taxes on the profits, even though they don't get the money. It's called phantom income tax, meaning, hey, I'm getting taxed on something that gets allocated to me, but I didn't actually receive. One of those situations that can absolutely drive an investor crazy. So we always want to take that into account when you have a longer term fund that you're expecting turnover of money, to ensure that to the most highest level, phantom income taxes don't become an issue for your business moving forward. There is actually some alternatives there. Most importantly, you could be doing it as a REIT, a real estate investment trust. And just kind of to mention it, even if people don't understand what a real estate investment trust is and you think it's a trust, generally it's a corporation or an LLC, and there's a bunch of different requirements underneath it. But even with that, there are requirements of paying out dividends of whatever the net profits are, the taxable profits. So if you're trying to compound and grow, it actually may be a better strategy for you for a really important reason. Even though you're supposed to be distributing at least 90% of taxable profits, and a lot of companies, a lot of REITs will do 100% of taxable profits to make the REIT tax neutral. However, it's taxable profits, not net profits. So you take into account all of the depreciation, all of the losses. And if you've been investing in real estate for long enough, you know how deep that depreciation can really affect the taxes on the front end. There may be recapture down the road, but it's really important to be able to enjoy that. So if you had that idea of, hey, I want to do this fund, but I really want to compound it and create this massive equity fund, there are options for you there as well. It is very technical. It's not something that you start without an attorney. And, just to kind of talk very basically about how these often are structured. If you are investing into stock of other companies, a fund of funds that you're investing into other funds, generally, it's as easy as you have some management entity, and we always use a management entity to provide that limited liability protections to yourself, the sponsors. And then you have the fund entity. And if you are investing into other securities, you just use the fund as the vehicle and you make the investments. And the other securities, it should never be a general partnership interest or other interests that there's not limited liability to begin with. And what limited liability actually means is you can lose as much money as you actually put in, but you can't lose more than that. As investors into your LLC or your limited partnership or your corporation for that matter, the investors should always have limited liability, meaning that, hey, they can lose their investment, but they shouldn't be able to lose their house. On the sponsor side, there may be personal guarantees for business loans or real estate loans, et cetera. So, but you're actually still in control over the level and how much risk you're willing to take. And if you're doing a equity fund where you're investing into other funds, fund of funds, or into other stock or other investment interests, you're generally not providing personal guarantees. So it can continue to help protect the sponsors, allowing for the limited liability, short of the securities risks, the investment advisor risks, and the investment company risks that I should have plenty of time to talk about. Now, if it's a real estate fund, there's just kind of a few extra steps. Generally, you'll still have that manager, you'll still have the fund itself, but underneath the fund, you don't want to just plug a bunch of real estate into the fund directly. It has unlimited liability. Exactly what I was just talking about. So the way that we deal with that one is you have, they call it SPEs, single purpose entities, special purpose entities, whatever. But they're wholly owned subsidiaries of the fund. And we just have the manager of the fund also as the manager of the subsidiaries. Each one of those subsidiaries owns a piece of real estate, however it may be put together or structured or targeted. Now, lenders actually also really very much prefer this structure because they don't have the risk of all the assets within the fund. They're just paying particular attention to hopefully these bankruptcy remote single purpose entities acquiring one asset and you have one owner. So it is very simple from an underwriting perspective just to deal with the loan at that level. Underwriting, they still take into account the overall structure, the fund and underwriting management, et cetera. But it does simplify their process. And then for the fund itself, it's really important to do this to protect, I've done a lot of asset protection in past life. With asset protection, you have like different directions that risk can come from. If you're the manager and you get sued, what's the risk to your company? If the company gets sued, what's the risk to you? And when you're dealing with real estate funds, there's, if something bad happens with one particular property, you don't want it to spread to all the other properties. And whatever you have within that same business entity is at risk for problems or issues within that same entity. So again, with the fund, it really has minimal real estate operations. So it's a limited liability member. It has limited liability, just like your investors do. It takes ownership of this wholly owned subsidiary, which owns the real estate, manages the real estate, and takes on the operational risks. But if something ever happens, baby falls down the elevator shaft, that's a horrible thought. But it could end up in a massive lawsuit beyond insurance, which is your first line of defense. And if a judgment creditor got a huge judgment, they can absolutely take whatever assets. They can foreclose on the assets of the, well, if it's a corporation. Some states for LLCs allow what's called charging orders, meaning they get all the profits. They don't take the ownership. Other states, the judgment creditors have the right to take ownership. Definitely is something to take into account, but across the board, we always use some sort of an SPE underneath the fund itself to own the properties. And kind of just depends on how ultimately you structure it. From this high-level manager LLC, you generally want the SPEs to be managed so that the controls are all the same, top to bottom. But with the property LLCs that's shown here, they always also should be 100% owned by the fund. And the reason for that is, again, just make your life a little bit easier. If it is a wholly owned subsidiary, that's an LLC, it defaults under the tax rules as a disregarded entity. It can file as a corporation if you want. In this case, you never want. As a disregarded entity, the LLC doesn't even have to file its own tax return. All of the tax information is filed with the fund itself. So for tax purposes, way easier. If you do have other owners, like it's a co-ownership vehicle, that can, you still have to file taxes there. So you may have multiple levels of taxes that are, required to come together. So it's not terribly expensive to maintain them at the state level. It's anywhere from $100 to $500 a year. If you don't have to pay for the tax prep, that tends to be about all you have to deal with, which is a nicer way to do it. All right, now to hit on this Investment Company Act. Investment Company Act of 1940, it is basically the laws that how to regulate, manage, and what gets reported for mutual funds and other investment companies. And what you're starting with any fund is technically an investment company. Depending how it's structured, there should be an exemption or different ways to kind of approach it. Now, if you don't have an exemption, you're basically get ready to file as a public company with all the quarterly reporting to the SEC, with audited financials every single year. Definitely is doable, but just the cost benefit, if you can qualify for an exemption, it's easiest to qualify for that exemption. And so to talk about the big ones, the 99 investor rule, just kind of as a standard, that's the easiest one when you're getting started to fit under. If you think about it, if your investors are in $100,000 range on average, you're still talking about $10 million. Not anything to be concerned about. And you can invest into any sort of passive opportunities. The fund of funds most often will fall under this 99 investor rule. And that's a really important component to pay attention to, because another very common traditional exemption is investing in real estate. But that's where people don't think about this, and where, hey, I'm going to start this fund and I'm going to invest into other syndications. So I'm investing into real estate and now I'm exempt, and so I don't need to worry about it. That's a problem, because what you're investing into isn't real estate. You're investing into other securities So that real estate exclusion doesn't apply. But you still can rely on this 99 investor option. Another major carve out are qualified purchasers. With the qualified purchasers, that just means they have net assets, not even net worth. They have assets of more than $5 million. In a general sense, that's usually used for, well, institutional investors working with other hedge funds. For all those, kind of this qualified purchaser, the SEC doesn't see that they have to really protect the institutional level investors. And something that keeps coming up, so I do want to reflect on this as well, is an investment company is making investments. Generally, the investments are passive, meaning going back to the Howey test, the original what's a securities test, combination of funds from investors that are pooled together for returns that are going to be from the efforts of others. I'm happy to go into more detail, not doing it now. But one of the big things is the passive investments seeking profits. Now, if you were to start a fund that owns subsidiaries underneath that are controlled by the fund and the fund's management, vertically integrated, then it's not a passive investment. It's just a business targeting multiple businesses or operations, that it's no different than starting an Apple. And you have all these Apple stores, and all these Apple stores are in all these separate LLCs, but they're owned by Apple. They're controlled by Apple. The policies and directions of the company are controlled by Apple. And Apple is not an investment company. It's an operating company that is just simply structured with controlled subsidiaries, majority-owned subsidiaries, managed subsidiaries underneath it, which takes it kind of out of the Investment Company Act consideration. So that's a big issue to consider if you're moving forward with an investment fund, and how to structure it to stay away from the Investment Company Act entirely, if at all possible. I'm going to skip over that since I just kind of touched on it. In terms of the securities exemptions, just to really note a couple that don't work. Regulation CF, literally regulation crowdfunding, there is an exclusion to that you're not allowed to do investment companies or funds underneath it, except for one type, a SPV, which means a special purpose vehicle. If you have a company that's set up, you can set up this SPV that can have 1,000 investors come in, invest that SPV, that special purpose vehicle, completely invest into the actual operating company. That's allowed with regulation CF, but you can't do any sort of real estate fund. You can't, or blind pools, you can't do equity funds. And well, ultimately you're capped at $5 million. So it's great for a syndication or a single deal. You can accept any type of investors, accredited or non-accredited, but you can't do these investment companies. There's a similar but different analysis with Regulation A. Regulation A, awesome. Again, you can raise up to $75 million from accredited or non-accredited investors. There's a little bit of extra work behind it, and you can invest into real estate all day long, but you can't set up any sort of investment company. One of the exclusions or ways to avoid the investment company is to have less than 45% of the assets and revenues from securities, equities, those investments. So are some limited ability to do some trading or do investing. Well, that's awkward. However, it does work perfectly great with real estate. You structure it the same way that we've kind of talked about it with the single purpose entities underneath it, owning the real estate itself. All of that works out great. You can even set them up where, well, it is more of looks like a syndication in terms of you can create separate classes, each for different real estate. So there's a lot of different options there. And then, of course, Reg D. I'm not going to get too deep into any of those, but if you have any questions, love to talk through it with you. Definitely reach out. But, really looking into 2022, just what's best for your business and whether it's going the route of a fund, which I'll get back to. If you've got the prior performance experience, the trust in your investors, it's going to make your life easier where you can diversify their interests, you can move a lot faster, and you don't have to have that deal right in front of you to continue your capitalization process. It's a great way to do it. In terms of actually getting it organized and going, if it's a Reg D, a couple of weeks, 2-3 weeks. If it's a Regulation A, now it's 3 to 6 months. We're generally getting them done faster, but it's just a longer process. So it's important to plan out what you're trying to accomplish for 2022. But one of the most important things from my perspective is who's your team and who are you relying on and expecting to meet your needs. And so I just kind of wanted to talk generally about who you need to make sure your team members are. And so if we happen to work with you on your fund or your deal, it's actually part of the first part of our conversation. Do you have these team members involved? And just to kind of touch on them, of course, bookkeeping. You need somebody to be in there making sure the accountings are done on a monthly basis, but they're generally not CPAs. They're generally the lower level accountants. Make sure you've got a great CPA that can handle any of your more complex considerations, tax planning, tax organization, and most importantly, has experience in the types of deals and structures that you're working with. Beyond that, from the attorney side, for God's sake, please don't do the securities without a competent securities attorney. Whether it's us or anybody else, the liabilities of not doing it properly include, but not limited to, going to jail if there's securities fraud or mismanagement of investor funds. The stealing from Peter to pay Paul. It happens so often, but unintentionally, where a sponsor may raise capital for one company, recognize that they have reserves there that they don't need for a while and use it someplace else. That is a major, major no-no. Something happens with either companies, kind of the house of cards may crumble. If it is ongoing and intentional, it could be a criminal act. Bernie Madoff, a great example of securities fraud that he got jail for ever, well, and now he's passed. Now that's a big risk, the biggest risk. But short of that, the implications are still really could be huge. Treble damages. If you mismanage or misuse investor funds. You tell them you're going to do A, B, and C, but then you go off and do X, Y, and Z. You're going to owe back to the investors every dollar that they invested. If it's for securities fraud, it could be triple their damages. But at the lowest level, even for not just organizing it, disclosing it, or putting your information out there properly, like I was saying, you can owe the investors all their money back if anything goes sideways, plus generally some court-ordered interest rate return. And the worst part about it all, you can't bankrupt out of it. These are debts that follow you in perpetuity. Real big reason when it comes to these securities, if you're working with investors, please, please, please work with competent counsel on that. And then you have your other attorneys. Generally with securities, it is so specialized. Most generalists, transactional attorneys don't touch it, don't understand it. The risks are too high, don't have malpractice insurance that covers it. And I will attest that it costs an arm and a leg to get coverage in this area. So there's a reason why it tends to be more expensive than getting a divorce is getting into investment deals. But in any case, you do always have a real estate attorney or your business attorney that handles the contracts, that can help with the financing. And at least in our case, we only focus on the securities, federal securities, coast to coast, and we work very symbiotically with other attorneys, which I think is a really important thing because some attorneys aren't easy to get along with. So just kind of, putting that out there. But then the other team members that you really need to make sure that you have, your technology. Nowadays, the old boiler rooms of the broker dealers, people pounding on the phone, it just doesn't happen. It's not effective anymore. Everybody should be thinking, how am I going to have my deal online? How am I going to be reporting to the investors online? How am I going to maintain all my information online? And there are some truly amazing, kind of all-inclusive online portals and technology firms that you can work with, some of which you point the investors to their site, others will embed their portal into your own website. There's quite a few different considerations and options of who you can work with. Then, of course, you're going to have your graphic designer. At the end of the day, no matter what, you have some flashy looking website or pitch deck or business plan or brochure. No matter what, you want to put your best foot forward, and the appearances always matter. So you need that graphic designer as well as a good financial analyst. They're not people that are full-time by any means, but when you're looking at opportunities, whether it's an investment into loans, real estate, securities, doesn't really matter. You want to have somebody that is knowledgeable on the financial analysis that can just simply tear apart the due diligence, run the Excel on what makes sense and what doesn't make sense. Again, one of those very important components, and the great to have, if you have it, is your financial backers, and beyond even just your investors, but do you have bridge lenders that if you're going to close on a property and come up a little short, do you have the resources or team members, oftentimes more of a general partner style position, that can make sure that financially things work smooth for you? So to get back to this little presentation with the only couple more minutes, so I'm wrapping up right here. You got to think about in your business plan, what's your goal? Where are you at in your business cycle? Are you younger? Haven't done a bunch of deals? Syndication makes a lot more sense. Do you have the track record? And it will always be a fund that is easier as long as you can bring in the investors. But you have your story. behind what you're trying to accomplish. Why are you trying to accomplish it? What are your goals? What's the story that gets not only for the planning part, but really presented to the investors? And once you know all that, at that point, you reach out to us or any other securities law firm, and then you just get the process moving forward. And like I was saying, it kind of depends on what type of securities exemption, qualification, or registration you approach. Some of them you can be raising capital in weeks, others will take months. Really, again, it just comes down to your story and your goals. So with that, like I said, it's 12:45 here. Exactly when I said I would. So Parker, I haven't paid attention to anything, so let me know what questions we may have.
Awesome. Yeah, Nate, that was an awesome presentation. I really appreciate you taking your time to do that. And I can tell the viewers liked it as well, just based off the questions and everyone that showed up. So yeah, let's jump into some of these questions we got here. You ready? Awesome, let's do it. So first question was, what are some common fees earned for putting funds together? Do you see fees and or percentages of equity? And if so, how much?
So it always comes down to the range of fees. So I did not talk about investment advisor RIAs situations. With those, if it falls under a RIA, there are rules within the Investment Advisor Act that you can only take performance fees, call it a promote, call it a carried interest, call it whatever. A performance fee, if you think about a hedge fund, that 2 and 20, that 20% of profits, that's a performance fee that under the Investment Advisor Act, you have to only be charging it to or working with qualified clients who actually have a net worth of 2.1 million. It may even be 2.2 million at this point or greater. So it's like the super accredited, but that is dealing with the funds, but only with investment advisory activities. Real estate funds, it doesn't apply. So oftentimes there is a promoted interest, and there's oftentimes the way the distributions are often structured is you have a preferred return anywhere from 5 to 8%, and then a profit split going to the investors, going to the sponsors, anywhere from 50 to 80%. Then when it comes to the fees, again, if it was the RIA, you really just structure it where it has a set assets under management fee. Perfectly fine when you're talking about a real estate offering. Very traditionally, you have asset management fees, which is a fee that you charge to manage the property managers. You have the property management fee. If you do it, great, you share in it or take it. If you hire a third party, you don't want to double dip on it. Then there's also acquisition fees or disposition fees, the purchase fee or the sale fee, which is usually tied to the purchase price of the assets. And really it's to go through the work of underwriting, finding the properties. Then when the properties have run their course, it's a compensation for the work of selling the properties. So that's a very traditional fee. Generally, it's between 1 or 2%. And then another fee that's very common are the finance or refinance fees, which is usually maybe 0.5% to 1.5% of loan amounts. And again, if you have time and efforts into anything on behalf of the fund, in my opinion, you should always have some sort of a fee attached, just like if you're going to your job. Go to your job, you get paid for your job. Same thing with managing a fund.
Awesome, man. Next question is, can Reg A be used for something other than real estate?
Reg A absolutely can be used for, well, starting a business. Once you've got your business moving forward, absolutely, it's a mini IPO. Once you go through the Reg A process, And I forgot one of the most important team members, especially with the Reg A's, is your transfer agent, because you may end up with thousands and thousands and thousands of investors. The transfer agents, part of the technology, keeps track of all that information. But I digress. The Reg A is like a mini IPO that if you're moving forward with your business and you're looking for a large amount of capital, and with Reg A, the shares, once they're issued, are free trading, meaning you can sell them once they've been sold to the investors. And there is, especially right now, secondary markets that are getting created for these Reg A shares. So long story short, absolutely you can do a Regulation A offering, not just for real estate, but also business. You just can't do it for investment companies unless you find an exclusion from it.
Love it, man. Next question would be, funds which acquire real estate need to use debt and require KPs for the loan. Is this an issue?
Definitely not. The way that you often structure it with the KPs is if it's on a property by property basis. You can have an investment contract or you structure the SPE to ensure there's sufficient controls for the KP to qualify as key KP, key person, generally guarantor. If they are high net worth and are serving as a KP for every property, you have them at the manager level, and then they're there to help all along the way.
All right, and we got the final question coming in here. It is real estate investments. When will a Reg A be an advantage?
The biggest advantage of the Reg A is, just to kind of touch on with the Reg D 506B, you can't advertise, but you can accept some sophisticated, unaccredited, and accredited investors, but you can't advertise. Reg D 506C, you can advertise, but you can't accept any unaccredited investors. With the Regulation A offerings, you can both advertise and you can accept any investor, accredited or non-accredited. Your only limit is they can only invest up to 10% of the greater of their net worth or income. But frankly, I don't see that as much limitation, because if you're taking more than that, you're looking for trouble nonetheless. So Reg A, you can raise money from everybody. You do have some ongoing reporting, but at the same time, as soon as the investors buy, they can also sell their shares also. So it just creates more exit opportunities, in addition to, on the marketing side, raise a whole bunch of money from a whole bunch of people.
Awesome. We actually got a question slipped in just right now. It was, define advertise in Reg A.
So and this is kind of more of a general statement to it, advertising meaning general solicitation. General solicitation means you can reach out through social media, through magazine ads, through billboards. You can do seminars with people that you don't know. To not do general solicitation means that you have a prior relationship with the investors. They're within your network. You actually know who they are. So just to speak on what is not, to speak on what is general solicitation, if you send out an email blast to the 10,000 people that are on your email list, and you've been sending them newsletters for years, but you actually haven't talked to a lot of them, you don't have actual knowledge of who they are, you don't have a prior relationship, that qualifies as a general solicitation, which would be allowed under Reg A or Reg D 506C. But that's one of those times that people may think that they're doing things without any issues, but it's a risk. So in terms of the advertising itself, there are compliance requirements behind it, such as, if you can't, nowadays, the SEC and FINRA, who manages broker dealers and RIAs and whatnot, they really focus heavily on advertisements and claims of profits. And there's specific rules about, hey, if you're going to claim that you're going to get 15% plus on that, then you better be able to back it up with quarters of, at least a couple of quarters of experience. But from a general sense, as long as the risk and reward is fairly balanced, you absolutely can do solicitations in various areas. And all these that are general solicitation, you can do with Regulation A, you can do with Regulation D, 506C.
Awesome, man. There's no more questions. I just want to take a few moments to say I really appreciate everyone coming on by and hanging out with Nate and myself. And we are planning on doing these webinars bi-weekly, I believe. So definitely check us out on Facebook, Instagram, Twitter, even LinkedIn. We'll always post whenever our next webinar is going to be, what the topic is, so you can stay on the loop with us. Nate, do you have any final thoughts? Anything you want to close out with?
The most important thing, I want to give everybody these t-shirts. So make sure that you touch base with us. Yeah. And so I can keep making more. If we don't get rid of them, I can't get more. And that's the funnest part of my job. Thank you, everybody.
All right. Thanks, everyone. Have a great day.